Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chris Verrone. Chris is a partner of Strategas and heads the firm's macro and technical research effort. Chris, how are you doing today?
I'm doing great, Ross. Always great to be back.
Great to have you. Great to chat with you. I wanted to start on the fixed income side of the world. One
Mm.
of your louder calls over the past couple of weeks has been this kind of gravity or heaviness behind yields that even in spite of the Fed's kind of hawkishness the other day,
Yeah.
that yields globally are pulling lower. I was wondering if you could expand on that a bit.
Yeah, I think that's really one of the big changes in our thinking over the last several months. I mean, for so many years, we've been in this rates higher, rates higher, rates higher camp. And then kind of as you move through October, November, December of last year, and now certainly into the new year, we have started to see the trends on not just the US, but all the global bond yields really start to change. And ultimately, at the end of the day, we're trend followers, and we're going to position in the direction of what we call of gravity. And I think the gravity is pulling rates down. Now, when we look at yesterday, which was the Fed meeting, there was a lot of talk that that Powell was more hawkish than maybe the market expected. Maybe equities got that impression, but the bond market did not. You know, where you look at yields today relative to where they were just a couple days ago, they are lower across the curve. So I still think this call of bond yields down is one that really resonates with us moving forward.
One of the other things that I've seen you use as a comp, and as we
Mm.
increasingly move towards what looks like an economic soft landing, is the
Yeah.
1995 comparison. And we know what the Fed did as far as rates there, but you've looked at the equity side of things, and I think there's an interesting lesson for today. Could you talk through some of your big takeaways in using that 94-95 comparison?
Yeah, that's a great question. This has been really at the top of every institutional meeting that we've done over the last several weeks, talking about what really sector lessons have we learned from that 1995 Fed cut. And the Fed went in July of 95. It was a non-recessionary cut. There were more that followed. When you look at the sector performance around that, there's a lot of randomness with two exceptions. The one exception on the positive side is financials outperformed before it, outperformed during it, and continued to do so afterwards. Financials were a clear leader in and around those Fed cuts in second half of 95. On the other side of the ledger, I thought the price action around technology was notable. Tech was a leader during the Fed hiking cycle of second half 94. Fed Tech continued to work as the Fed paused in first half 95. Then they go, I think, on July 6th of 95, Fed cuts, and it actually put the relative performance top in the technology sector for the better part of the next 12 months. Now, we know how great tech would be after that in 97 and 98 and so on. But for about 12 months there, as the Fed was cutting in late 95 into 96, it was not as bullish for tech as the consensus expected. The tech sector kind of went sideways in price, but underperformed in relative terms. So I just want to put that out there. Financials were very good. I think tech acted differently than the consensus would have anticipated during that period.
Well, let's finish with tech then.
Yeah.
The leadership all of 2023, the concentration at the top of the
Mm.
market, big stories, and then at the end of the year, you get this big broadening out. Small caps, other
Yeah.
kind of beleaguered sectors start to work. Can you, a month into the year, can you give us an update on that idea of maybe the big tech behemoths versus the rest of the S&P 500 and how that's looking, for the first 30 days of the year or so?
Yeah, I wouldn't say it's terribly different than perhaps maybe how the second half of 2023 went. There's been some hints, certainly, of breadth improvement. We saw that to end last year, take a little bit of a backseat the first month of 2024. When I look at tech in particular, I think if there's going to be a big problem with tech down the road, we need to get some flesh wounds there first. And it's still a very broad sector within technology. The eco weight tech, for example, is really holding in just as good as the cap weight tech has. I know there's some corrective price action here with some of the semis over the last several days, so on and so forth. But if you look at how sectors typically top, they tend to deteriorate from within first and over a period of months. I'm not saying that can't happen over the next number of months, but you tend not to top from your strongest internal condition, and tech is still pretty strong internally. So we'll watch how that evolves over coming months. One metric in particular that we pay attention to is the percent of stocks above the 200-day moving average. That's still pretty broad for tech as a sector. Frankly, it's still pretty good for the market as a whole here. So I know there's been a little anxiety the first couple weeks of the year, first month of the year, about some of those broadening signals we saw in late 23 really not following through. Let's give this a little bit of time here. February and March can be weak seasonal months anyway. I think the integrity of this market is still pretty much largely intact, though.
Well, that's good to hear. Hopefully we'll get a chance to catch up with you on the other side of that rough seasonal patch. But in the meantime, Chris, thank you so much for the time today. We'll look forward to next time.
Thanks for having me.